Well, good morning and welcome. We're at the start of another fresh week. My name is Harsh Saita and with me is Ankita Saxena. You're watching Market Cafe, and over the next 1 hour, we'll take you through all that's happening through global news, global headlines, as well as markets, what are they up to, and lastly, what's happening on the domestic front, including specific corporate news. So let's quickly get straight to it. Ankita, talk to us about where global markets closed on Friday and what kind of a handover do we see on Monday morning.
So good morning to you, Harsh, and good morning to everyone. It's the start of fresh week, but on Friday we did see the markets come back. I mean, we did see a sell-off coming in last week for US markets, but on Friday the markets rallied primarily on the back of earnings and a note that came out by JP Morgan. So all the major indices closed higher, snapping a 4-day losing streak. Gains were led by Apple and regional banks that climbed off the lows. Apple gained 5% after beating the street expectations on their numbers. We also saw the regional banks rebound as a bullish note came out from JP Morgan that really helped the indices gain in the trade. Dow Jones added 546 points or was up more than 1.5%. The S&P 500 climbed 1.8% and the Nasdaq advanced 2.2% in trade. Now, Dow and the S&P 500 logged their worst week since March because we did see the sell-off come in before Friday. We did see a major sell-off come in the US markets. Now, Dow lost 1.24%, while the S&P 500 dropped 0.8% for the week. The Nasdaq, however, managed to eke out a small weekly gain of 0.07%, largely flat, but managed to eke out that gain. Now, the US market, the US economy added 253,000 jobs in April versus the estimates of 180,000 jobs. That was the data that came out over the weekend, the jobs data. It is hinting towards a rather robust labor market. We were penciling in 180,000 add-ons to the job, but it did come out more than what was expected. Now, also today, we are expecting a US March wholesale inventories that will come out. So that is a number that will be watched very closely. In the European markets also closed higher on Friday. Adidas came out, was pretty resilient, was up 8% after a strong growth in the quarter earnings. The British pound also hit its one-year high. The Pan-European Stock 600 closed up 1.1% with banking and oil and gas stocks leading the gains. DAX was up 1.4%, FTSE up 0.9%, and CSE was up 1.2% in trade, Harsh. So a sea of green coming in on Friday.
Well, yes, we saw that on oil as well, Ankita. So we did see oil move up a little bit, show a bit of a recovery, which is a positive when it comes to the way in which oil had fallen. So we have, WTI at around $71.35 a barrel and Brent just above the $75 a barrel mark. Clearly a recovery. But what's leading it? One is, of course, there's a possible OPEC Plus meeting again in June where they could continue to cut back on production given the fact that there is pressure on oil prices. So that's point number one. Point number two, of course, is there was a bit of a recovery rally coming in the US as well. So things look slightly better on the GDP front, and that's what's really aiding oil as well. Of course, the resolution in the banking system, the whole hog kind of helps oil, stay at that particular price point. So currently, oil seeing a bit of a, rebound that we can see, but that was on Friday. Today, it's opened absolutely flat. We are where we are, and that's currently where oil is.
All right, then let's quickly go across and look at the events that we need to keep a track of. As of today, we have Kansai Narrowlag that will be considering an issuance of bonus equity shares. And tomorrow we have Raymond that will consider the issue of NCDs of up to 2,200 crores. And the lock-in period opens on 55% shares of DCX Systems as of tomorrow. On 10th of May, we have the R Systems that will be meeting on completion of share acquisition, and Global Health, the lock-in period opens on the 66% shares. On 11th of May, we have the lock-in period opening up on 64% of shares on BKG, and in IPO action tomorrow we have Of course, we have a major listing that's happening. We have Mankind Pharma that will be listing on the bourses tomorrow. And we also have Nexus Select Trust IPO that will open for subscription from the 9th of May to the 11th of May. On the 12th of May, we have the Indian Industrial Production CPI number that will be coming out. And in the global cues, we have the US CPI number that's going to come out on the 10th of May. PPI, initial jobless claims, on the 11th of May, and the UK Bank of England rate decision that will be coming out on the 11th of May. So that's the roundup of the action that we have in this week, Harsh.
Well, yes, Ankita, but let's talk about what was the action on the weekend. Essentially, it was the Berkshire Hathaway meet. And, you know, I was glued to my screen on Saturday evening, all through the late evening. And that was the big news flow that we were tracking over the weekend as well. Now, Berkshire Hathaway's AGM is known to be a mecca for value investors. And despite the ongoing volatility and fears over the US economy slipping into a recession, the Berkshire Hathaway chief, Warren Buffett, pumped in a sense of calm, not completely ruling out economic turbulence in the coming months. He though said that the government backing could face more pressure even as the government backing for collapsing banks helped restore depositor faith. Buffett also noted that his businesses will see lower year-over-year earnings as well as economic activity as economic activity slows down. He continued to express optimism of the US dollar. He said he doesn't expect the currency to be dethroned anytime soon. Buffett's 99-year-old right hand, who's Charlie Munger, commented on AI, and he said that while he is going to see a lot of more robotics in the world, he remains skeptical of some of the hype in AI.
And the US economy created more than 253,000 jobs in April. The Labor Department reported that this marks a surprise jump from the March numbers and shows just how resilient the labor market remains despite rising interest rates and high inflation in the US.
Right, and in some worrying commentary, the US Treasury Secretary Janet Yellen said that failure to raise the debt ceiling will likely cause a steep economic downturn in the country. She also flagged worries over the Treasury Department running out of measures to pay its debt obligations by June.
And in another important global event that unfolded over the weekend, it's the first coronation in 7 decades in the United Kingdom. King Charles III takes the royal oath, has been crowned the monarch of the United Kingdom and 14 other Commonwealth nations.
Well, and switching to crypto exchange Binance has resumed Bitcoin withdrawals after a brief closure due to a congestion issue. The exchange says it is currently working on a fix until the network is stabilized and will reopen Bitcoin withdrawals as soon as possible.
And the head of Russia's Wagner Group appears to have ditched plans to withdraw forces from Ukraine's Bakhmut after being promised more ammunition by Moscow. The mercenary group also suggested that might keep up their assault in what Russia sees as a stepping stone to the rest of the Donbas region.
Right, with that we'll slip into a very short break. More on the other side. We'll start going domestic, of course. Welcome back. You're watching Market Cafe on ET Now. Now, we'll jump straight into corporate because there are a ton of announcements, ton of earnings, as well as conference calls to focus on. So we'll shift focus to Coal India. Now, they've reported their Q4 numbers on Sunday, which is yesterday. My colleague Sharad is standing by with the earnings fine print. Sharad, help us understand the performance for the quarter gone by.
Well, yes, in focus we are having Coal India, and where we see the numbers were in line, but do remember there has been an important adjustment of higher wage provisioning. Now, because of that, what happens is the numbers come in weak set of numbers. Now, apart from this, of course, if you look at the revenue numbers, they have been higher than estimates, and this is because of two reasons coming in. Of course, this is the higher realizations as well as strong volumes. Now, if you actually have a higher wage provisioning, then it was an EBITDA miss as per the estimates. But if you remove that adjustment, then the numbers were largely in line. Now, headline numbers, if you look at it, revenue went up almost 17%, but the impact of higher wage provisioning, that actually weighed down on the bottom line numbers. We saw EBITDA falling almost 24%, while PAT also took a hit of almost 18% on a year-on-year basis. Now, looking at the operational numbers in focus, the offtake went up by 6% on a year-on-year basis, while the supply to the power sector also kind of increased by more than 5%. The volume stood up almost 12%, while the FSA realization that went up by 5% on a year-on-year basis. Apart from that, overall, if you look at the numbers operationally, there was a kind of a mixed numbers because the e-auction volumes did dip, but the higher realization made up for the decline in the volume. So overall, we could say inline set of numbers have come, but financially, if you look at the impact of higher wage provisioning, it comes in weak.
All right, thank you so much for those details, Sharad. Then we'll move on then. Cash-strapped airline Go First has been in news. It has cancelled all its flights till the May 12th, citing operational reasons. Now, initially, the airlines cancelled all the flights for 3 days, starting from the May 3rd, now, which was extended, of course, till the May 9th. Now, the airlines has assured full refund for its travellers, but the consumers will still bear the brunt, as their fares of routes with a strong Go First presence have surged by as much as 25%. My colleague Sumit Chaturvedi gets us more on this.
Well, absolutely, Go First has shaken the market. Not in a good way. For some, it's a bad thing, and for some, it's a good thing. Like for competitors, for consumer, it's a bad thing. Naturally, airfares have gone up. For non-metros route, where there is a good tourism traffic, the overall fares have gone up by up to 25%. We're talking about Delhi-Leh circuit, Delhi-Srinagar circuit, or Delhi-Bagh-Dogra circuit, or Mumbai to Goa circuit. 25%, up to 25% airfare has gone up there. On the metro routes, it's by up to 15% because there is more capacity. So it's clearly not a very good time for customers when they go. And in the coming months, or in June and July, when there's a good period of because of the school holidays, it's going to go up further. We know that certain now, sometimes government is also trying to do something from the other way so that airlines can be told to increase capacity on the routes so that fares can be brought down. But they are not coming down, and they have increased, especially in the last 2-3 days since Go First said that it's going to extend the cancellation of flights.
Right, now this is an ET Now news break confirmed. The Aditya Birla Group firm ABFRL-TCNS has entered into definitive agreements to acquire 51% stake in TCNS Clothing, which owns the ethnic brands such as W. Aurelia, Wishful, Folk Song and 11. Vamakshi joins in with all the details on this one. Good morning, Vamakshi.
Well, yes, Aditya Birla as well as TCNS, both of these companies will be in focus as Aditya Birla ABFRL is looking to buy 51% stake in TCNS for rupees 1,650 crores, which is expected to be a combination of open offer as well as acquisition of stake from the promoter. Now, post the stake purchase, Aditya Birla ABFRL, TCNS rather, would be merged into Aditya Birla, wherein 11 shares of ABFRL will be given for 6 shares of TCNS. The merger ratio, however, is expected to be negative for the minority shareholders of TCNS, as it implies a share price of 393 per share versus the current market price of around 520. In fact, for ABFRL shareholders, the merger is expected to lead to a share dilution of almost 5.7%. Now, overall, let's assess the impact of this development on both the companies. As far as ABFRL is concerned, it is expected to be positive for this counter, as the transaction is happening at a valuation that is lower versus successful apparel retailer brands, which trade at valuations in excess of 30 times. Debt, however, should not increase for this counter, as we're expecting a pending inflow of almost 1,450 crores from GIC. However, this deal is negative for TCNS, as the company is valued at a discount. Minority shareholders would be better off by tendering their shares in the open offer, and the implied merger value of 393 is actually coming at a discount of of almost 7% even when we compare it to the 52-week low. Apart from that, we also have a note that came in from Morgan Stanley, and they've highlighted that given the structure of the deal and the pending cash inflow, the balance sheet impact could be lower than feared on ABFRL. With most businesses still in work in progress and growth phases, they are worried about execution challenges. So given these factors, Morgan Stanley has actually maintained an underweight call given a target price of 195 per share. So positive for ABFRL and negative for TCNS is the word that we have.
All right, thank you for those details, Mamakshi. And we will watch out for all those stocks, but there is another stock that will be in focus as of today, and that is the FMCG major Britannia that reported a 47% year-on-year rise in consolidated net profits for the March quarter to 559 crores on the back of an over 13% growth in the revenues to 4,000 crores. Now, FY23, the company reported a 52.3% year-on-year rise in the consolidated net profit to 2,322 crores. My colleague Winnie, who tracks the sector very closely, is here with more details. Take it away, Winnie.
So good morning, and starting with Britannia, when you talk about it, the numbers were a good set of numbers, especially on the operating performance front. It was a very good set of numbers. Revenue saw a good growth as well. When you look at the other operating revenue, that saw a sharp rise as well, and that was mainly because the company had started receiving the amount for the PLI scheme which they had won, and this is for the last couple of years. The company also highlighted in its con call that going forward every quarter there will be a 15 to 20 crore amount that they'll be receiving for the PLI scheme. So all in all, it was a good set of numbers that came in from the company. More of a pricing-led growth this time around. Our volumes are at around 2 to 3% is what the company highlighted. Margins have remained flat sequentially, but look at on a year-on-year basis, I beg your pardon, a strong performance coming in over there. The company further highlights that going forward, obviously this pricing-led growth will taper off. Price cuts will lead to sequential contraction, maybe slight bit in terms of the margins of the company as well. But as of now, all in all, it was a good set of numbers coming in from Britannia. Enhanced direct reach is something that is fueling the top line growth as well. Bread is continuing to see a good growth and marching forward as well. And in terms of brokerages, they seem to have increased the target price for Britannia as well. Jeffries has increased the target price to 5,300 rupees from previous 5,200 rupees, maintaining a buy rating on the company post the beat that came in Q4's margins for Britannia as well.
Right, Vinny, thanks for that. But stick with us while we listen in to what the management had to say on where they see gross margins and volume growth headed in FY24.
It will hover around the same, maybe, a percent here or a percent there. Won't make a big difference. The point is that we might have to make a few changes to pricing in certain brands in certain packs. So we don't want to become, only margin hungry and not continue our march on revenue growth, volume growth, and market share growth. So it has to be a balanced play, and that's what we are trying to do. And that's how we've, looked at getting the golden triangle every year. But I don't worry too much about volume. I'm more worried about the number of packs that we sell. So I would want to see aggressive growth as far as number of packs that we sell. But yes, you're right, even volume growth will definitely pick up in this year.
All right, then keeping with the FMCG pack, Marico also reported its Q4 numbers, and Vinny is standing by with all the number crunching. Over to you, Vinny.
So in terms of numbers from Marico, a decent set of numbers has come in from Marico as well. The domestic volumes grew by 5% on a year-on-year basis. However, the value growth, when you look at it, that has just remained at 2%, mainly due to the price cuts that we saw for Parachute coconut oil as well as Saffola edible oil as well. We've seen palm oil prices had seen a bit of a correction, so Marico has also passed on that benefit to the consumers as well. So obviously, value growth was a bit lower. Now, in terms of the Saffola franchisee, when you look at it, that has slipped 9% on a year-on-year basis during this quarter. Parachute volumes, on the other hand, have seen a bit of a rise there, and 9% rise on a year-on-year basis, with market share gains is what the company is highlighting of around 70 basis points as well. Even the international business has seen a growth of 16% on a year-on-year basis in CC terms. Brokerages, Morgan Stanley maintaining an overweight rating, target price of 582 rupees per share. Q4 earnings, they said, were largely in line with what they were estimating. Improving growth, margins were positive. Key positives that came in from Marico, and management sounded quite confident in terms of the outlook for FY24. So yes, brokerages seem to be giving a thumbs up to Marico as well.
Right, thanks for that, Vinny. Of course, the other company which was in focus through the weekend was Paytm. They came out with their numbers on Friday, had their con call on Saturday, and we saw revenue to be largely in line with what the street was penciling in. Revenues come in at 2334 crore, which is a 15%, 51%, I beg your pardon, jump on a year-on-year basis and a 13% sequential jump. With regard to the net loss, though, net loss came in at 168 crore versus what the street was penciling in at around 350 odd crore. So that came in massively positive, and even the commentary largely was positive. OPEX was controlled, which is what aided the loss after tax figure, and contribution profit jumped 23% on a quarter-on-quarter basis. Contribution margins came in at 55% versus 51% quarter-on-quarter. So going from strength to strength with regard to its profitability as well as with regard to its numbers where Paytm is concerned. Indirect expenses on the back of that grew just 16% year on year, maybe 4.5% when I'm looking at it sequentially. EBITDA before ESOP, in fact, EBITDA before ESOP margin has come in at 10% versus the 2% number same time last quarter, and 24% same negative margin same time last year. So you're clearly seeing that tailwind come in on Paytm. The management has guided for profitability very, very shortly, and what they're also suggesting is that they will be cash flow positive. That's more important because Paytm has 8,000 plus crore of cash. What they do with that $1 billion plus of cash is obviously a question mark. Need to wait and watch as to what they will do with it going forward, whether they want to invest it or do a buyback, which is what they've done in the last quarter. But keep your eye out, Paytm will be in focus. Now let's quickly listen in to what the management had to say on their Q4 earnings, especially with regard to profitability.
We have not given a specific quarter, but we have said that we are very close to achieving cash flow profitability. And just to be clear, the way we define cash flow profitability is EBITDA plus interest income less CapEx. There is also in parallel improvements in working capital that we are doing. So if you notice over the last 1 year, due to improvements in working capital, and if you adjust for the money that we spend on buyback, we over the last year have actually added to our cash. If you look at the March 31, 22 number and the March 31, 23 number. So we have also in parallel improved working capital. But when we are talking about free cash flow, we're saying EBITDA plus interest income less CapEx. And we are very close to being able to do that. You only need some improvement in EBITDA going forward, not very significant improvements in EBITDA to be able to get to free cash flow breakeven. At the moment, we do feel like we have a lot more cash than we have immediate use for. One of the things that we have done in the past is discuss with our board and return some of that in the form of buyback. So that would be one option on the table, and there would be other options with respect to any investment areas that we feel very strongly about.
And well, after that earnings beat, Paytm's founder and CEO Vijay Shekhar Sharma wrote a letter to the shareholders where he said that the next milestone is to make the company free cash flow positive in the near future. He added that the focus is on quality revenue, which is aiding the bottom line, and the incremental business continues to generate better margins. Now, Sharma also believes that with the advent of early stage AGI, which is artificial general intelligence, in 2023, there will be more opportunities to bring efficiencies in the business and AI-first offerings. The company's technology teams have already started to see encouraging results. Sharma sees AGI as something like smartphones 10 years back, ripe for innovation and potent to become a part of everyday life at scale. As a technology company, he said that Paytm will be at the forefront of this revolution. Paytm is on track for its vision to bring 10 crore merchants and 50 crore as payment users in the near future, he added.
Right, strong commentary coming there from Paytm, but with that we'll slip into a very short break. More on the other side, do stay tuned. Right. We'll continue to focus on domestic. Financials and manufacturing are the mega themes for the coming decades, believes ValueQuest Investments Ravi Dharamshi. Listen in to his views on both of these sectors.
I think out of the $40 billion outflow that happened, $20 billion went out of financials. Now you just juxtapose it with the fact that US regional banking is facing a severe crisis. The larger banks are being called upon to support the smaller banks. And of course, yesterday Fed made a statement that, that was an exception. It's not likely to happen. But what that tells you is that elsewhere, there are problems created by the lending sector. While in India, it is the strongest sector. In fact, nobody talks about an asset quality deterioration or any of those things. All we keep discussing is, will there be an impact on the NIMs? Is the growth going to be high enough or no? And in fact, I find financials as the only place in the market where there is a combination of growth as well as value. Most of the places have growth, then the valuations are not in your favor. Or if the valuations are in your favor, then there is no growth on the horizon. So financials is the only place which has growth plus value and will be the first port of call for any foreign money that will be coming into India. And I think what will happen is maybe the second tier and the third tier rung in the financials will also start benefiting from this. So now we are witnessing probably some change of guard. We have already witnessed a change of guard in the large banks. Probably we are going to witness a change of guard in the large NBFCs as well. So some of the performing ones will probably get outpriced before they even come down.
Or are we from a real recovery in pharma where you would say that the excitement of 2021 is over and the pain of 2022 is something what markets have factored in?
So we had almost 16, 17 months of consolidation period. So clearly we dealt with the storm in a very, very mature way. It was more a time correction. We have digested all the bad news and we have digested the euphoria of 21 as well. See, there were some sectors which ended up, or some companies that ended up losing 50-60%. Otherwise, most of them managed to hold on to their gain with a 10-20% kind of a loss. So I think that period of correction, consolidation is getting over. The period of wealth creation is coming back as RBI has already paused, and some of the other factors of profitability are also coming into favor. So basically, see, India never had a balance sheet problem. India only had a P&L problem, and that was coming from the raw material inflation, freight cost increase, and some slowdown in growth. I think the raw material inflation has already eased, freight cost has already come down. The growth slowdown that came about has kind of been factored in most places, but there is probably export-facing sectors still have some amount of growth slowdown, maybe a couple of quarters. But besides that, I think at an aggregate level, India has recovered very well. And once growth comes back, in fact, the operating leverage will also come back, with leading to margin improvement. In fact, this quarter, we are already witnessing some of the leaders in industrials, manufacturing, auto ancillaries, financials are seeing some margin expansion, which was not an expected phenomenon, I would say.
Ravi, hi, morning. We've sort of borrowed this line from you, the manufacturing renaissance, as you so well described it. And, you've talked about some top emerging themes in order to capitalize on this manufacturing growth. So can you just, walk us through what exactly those are?
So, I think confluence of factors. One, China wants to move away from manufacturing. Maybe it is because of pollution issues, maybe because they want to move their economy away from export-oriented to consumption-oriented. China wants to move away. Second is, world wants to move away from China in terms of their dependence, because of their over-dependence on supply chain terms on the China. And India has a huge populace that needs employment, and the kind of employment that manufacturing can generate cannot be generated by services sector. So we have no choice but to grow our manufacturing sector. Now, government is taking all the steps required to give the boost to the manufacturing sector. But it is not an easy journey. But we are already witnessing some early signs. So for example, in electronics, I think we are in mobile, especially within electronics, We have become net exporters. I think that's a huge benefit for Indian economy. So we had a structural issue because we always used to run.
All right, then with that, we have Vamakshi standing by with all the brokerage notes that came in this morning. Vamakshi, tell us what are the stocks that we need to keep an eye out for? What are the brokerages saying?
Well, absolutely. Let's first start off with United Breweries. We have a note that is coming in from JP Morgan. Now, they believe that the margins have bottomed out for this counter, but given the lower margin assumptions, they've actually cut their FY24 as well as 25 EBITDA estimates by around 4 to 5%. They believe that the company is now focusing on premiumization, and apart from that, the summer demand is a key monitorable for this counter. So, given all those factors, JP Morgan has actually maintained a neutral rating on United Breweries, but nevertheless cut its target price to 1,460 from around 1,550 per share. Next, a stock on our radar is IndusInd Bank. We have a note that has come in from Jefferies, and they've highlighted that the resignation of the CRO shouldn't warrant such a price correction. They also believe that the valuations are attractive at 1.3 times FY24 adjusted PB, and given those factors, IndusInd Bank Jefferies actually has maintained a buy rating with a target price of 1,550 per share. And lastly, let's watch out for Federal Bank. We have a note that has come in from Morgan Stanley, and they believe that in the fourth quarter, the key negative news was weaker than expected margins. Now, they've also gone ahead and cut their EPS estimates by around 5% for FY24 and 10% for FY25, largely owing to lower margins. The stock is appearing to be cheap, but the downgrade is seen as the re-rating cycle seems likely to be delayed. So overall, given all those factors, Morgan Stanley has in fact downgraded their rating on Federal Bank to equal weight from overweight, and also cut their target price from 175 per share to 145 per share.
Right, thanks for all of that, Vamakshi. Let's quickly go to Vinny, who's again standing by. Vinny, talk to us about all the stocks that we need to keep on our radar for the trading session today.
Good morning, and we'll start with SJVN. Now, this one is going to be in focus because its wholly owned subsidiary SJVN Green Energy has won an 800 crore order from the state of Gujarat, the Gujarat government, and this is around a 100 megawatt order which is they have received. Moving on, let's talk about United Breweries in terms of news flows as well, because the company has taken price increases across multiple states, and the company is in the process of discussion with other states as well to increase prices over there as well. What analysts believe that maybe in Q1 FY24 we could see an headwind in terms of the margins for the company. Alembic Pharma, on the back of its numbers, is going to be in focus. A good set of numbers was reported by the company. Revenue remained flat, but profits saw a 6 times growth on a year-on-year basis. DCB Bank, strong numbers coming in from DCB Bank as well, and I at 28% growth on a year-on-year basis. GNPA and NPA, so the asset quality of the companies have started improving on a quarter-on-quarter basis as well. Provisioning, a reduction in terms of the provisioning that has come in, provisioning at 52 crores versus 67 crores last year and 40 crores in last quarter. So keeping an eye out on that as well. Equity Small Finance Bank, good set of numbers. 28% growth in NII, profit seeing an improvement of 60%, asset quality improving considerably for Equitas Small Finance Bank as well. Electra Green, that one is in focus. Green Tech is in focus on the back of a strong set of numbers as well. Revenue around a 40% growth there. Profitability also seeing a strong improvement of 54% on a year-on-year basis. Lastly, Blue Dart, weak set of numbers was reported by the company. We're seeing that the revenues are up only by 4% and profits have seen a sharp decline of 50%. So keep an eye out on these companies on the back of earnings as well as news flow.
Right, then thank you so much for that, Vinny. We will be keeping an eye out on all these stocks in the trading session. Moving on then, KK Mistry, who's the Vice Chairman and CEO of HDFC, expects to see strong growth ahead. He also expects mid-teens to higher teens growth in FY25. Listen in to what he had to say.
So I would say my sense is that you would see a strong growth in the year ahead. On a standalone basis, as HDFC is today with our existing distribution machinery, we would expect the mid-teens to slightly higher teens kind of a growth even next year. But when you move into a banking structure, because of the much larger distribution framework, the much larger distribution platform of the bank, the massive amount of under-penetration of housing loans amongst the bank customers, logically one would expect the growth numbers to be strong. Now, when you compare first quarter and fourth quarter, there's a bit of an anomaly because the first quarter of last year had the COVID impact. So you saw higher growth in that first quarter as a consequence of the fact that in April, May of 2020, May of 2021, there was an impact of the second wave of COVID. Whereas when you look at the third and the fourth quarter, even in the third and fourth quarter of 2021 calendar year, there was complete normalcy in the economy and there was no COVID impact.
Right, let's switch focus. Consumer demand for air conditioners continues to be quite strong, according to Veer S. Advani, who's the Vice Chairman and Managing Director at Blue Star. Listen in to what he had to say about the demand in the sector and the reasons for a surprise uptake in margins.
So FY22 gross margins were one of the lowest we've ever had. We were severely hit in FY22. So we had an internal plan. Of course, as always, we say price increases we will try and do, which we did manage to do in the first half of the year, but then we were not able to increase prices anymore. We have taken up a fairly extensive and large total cost management program in the company, redesigning products, taking out cost, repositioning products in the market, all based on our significant investments in R&D and innovation. So because of those, we were able to bring down our cost of the products. If you look at the quarter-on-quarter improvement, so for the full year, gross margins would have improved about 50 basis points. But if you look at standalone Q4, you will see a big jump in gross margin, about 2.5% to 3%, if I'm not mistaken. If I step back and I look at consumer demand and try and understand whether a room air conditioner is in their purchase set, I would confirm that, in fact, room air conditioner demand is very strong. I think as an industry, I think we closed last year at about 8.5 million units overall. We're all confident in the industry that we should grow by about 20% in the current year.
Well, all right. With that, we're completely out of time on this one. Harsh and I will take your leave. Don't go anywhere. The market will take the action forward.